All right, greetings all. This is it. This is another videotaping of our meeting here at True Colors, and we thank you for hosting our speaker and our situation. So we're going to start off with the pledge. I'm going to say a joke. Really no announcements, but here we go. I pledge allegiance to the flag, to the United States of America, and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. All right. I have a joke. I happened to find one. I'm not a football watcher like a lot of you are, so y'all gonna get this one other than me. So anyway, Tom Brady, after living a full life, died before the Super Bowl. It was really kind of bad. And when he got to heaven, God was showing him around. They came to a nice little house with a faded parrot's flag in the window. "This house is yours for eternity, Tom," said God. "This is a very special, not everybody gets a house up here." Tom felt special, and indeed, he walked up to his house. On his way up to the porch, he noticed another house just around the corner. It was a huge 3-story mansion with red and gold sidewalks and a driveway, a 50-foot tall flagpole with an enormous Chiefs flag waving, a swimming pool in the shape of an arrowhead, a KC logo in every window, and a number 15 Patrick Mahomes jersey on the front door. I guess y'all know who he is.
We know.
Okay. Tom looked at God and said, "God, I'm not trying to be ungrateful, but I have a question. I was an all-pro quarterback. I won 5 Super Bowls and even went to the Hall of Fame." God said, "So what's your point, Tom?" "Well, why does Patrick Mahomes get a better house than me?" God chuckled and said, "Tom, that's not Patrick's house, it's mine." So, without further ado, Jim Francis is going to introduce our speaker today, and I'm going to back out and let him have fun.
Well, I always like to introduce Jason. I've done it a few times, and he keeps going and keeps doing good things. But let me just tell you a little bit about Jason. Most of you know something because he's been with us many times, spoken to us many times. We were just talking about his pen collection, which is growing. Jason has been in the financial business since 1999. And along about 2005, he and Rob Penn formed Pathfinder Wealth Consulting. So they've been going at it now 20 years. And nearly 20 years, and doing a great job. Jason has all the credentials you need to sell and manage all kinds of investments, and he's done a great job at it. He's also got a good educational background, graduated with honors from UNCW in finance, both bachelor's and master's degree. He's very active in the community. And as far as the business goes, something important. He's seen the good, bad, and the ugly over the years. So he can talk just about anything you want to talk about, financial-wise. So it's always a pleasure to welcome Jason back. Good to see you again, sir.
You as well, Jim. Thank you. Great. Good morning, gentlemen. I assume you're watching it in the morning, but now that it's video, it could be any time that you're watching it. I have recorded my presentation beforehand, and so that will be coming on next. It is our usual beginning of the year outlook that we talk about the economy and the investment markets. I'll say it in the video, but it is a look at the past, a look at where we are, and a look at where we're maybe going in the future. I really appreciate being here again. Because I can't take questions and answers this time around, I would still share with you. Please feel free to email me, jason@pathfinderwc.com, which I mentioned at the end of the video as well. So I have been enjoying my pen collection. I've been using it a lot more since we're all stuck inside a little bit. I can't wait to see you again in person, and I hope everyone's safe and healthy. And have a great 2021.
Welcome
Welcome to the Pathfinder 2021 Investment Outlook. And our title is On the Road to a New Normal. We're certainly glad you're here, and I know that everyone's glad to get 2020 behind us. I would like to start just generally by saying this outlook is our opinion, and our opinion changes depending on what happens in the world. And as you could tell from last year, things can change quickly. Also, investing involves risk, and that's another disclaimer I must mention as well. And so you'll hear us talk about investments, and just know that this is general guidance and not specific to your personal situation. So our format for this every year is where we've been, where we are now, and where we may be going. And certainly where we've been is a topic we're going to have to discuss again, although most of us want to get it behind us. But that brings us into today. And then we can also start looking at some ideas about what the future may hold. But before we get started, I always like to start with a good set of quiz questions to wake up that brain. And this year in particular, you may have been quarantined a little too long, and we need to get that brain fresh for this presentation. So the first question on our quiz today, what was Webster's 2020 word of the year? Was it coronavirus, COVID-19, pandemic, or Schadenfreude? And every year they come out and ask which word was the word of the year, and they do it by statistical analysis, most of the time by what is searched. And this past year was pandemic, which is an outbreak of a disease that occurs over a wide geographic area and typically affects a significant portion of the population. Well, that is certainly what we faced in 2020 and continue to face today. All of those words were words that were sought out in 2020, by the way. Next question. 2020 was a year for self-discovery. Essayist Emily Gold wrote in The Atlantic, "One exciting thing about being alive at this pivotal moment in history is that I'm constantly learning about strong opinions that I didn't previously know I had." And what do you think that she was writing about? Was it virtual school, bread recipes, remote work, or pandemic dating? If you guessed virtual school, you're right. And here's her further quote mentioning, "My hatred comes, rather, from having coached my 5-year-old son, Rafi, through virtual schooling in the spring. To say that virtual pre-K didn't go well would be an understatement. Eventually, we scaled back to requiring Rafi scrawl his name and a few letters and numbers before we just headed out to the park in the morning." And I know this resonates with a lot of folks out there who are trying to work, trying to teach their kids, trying to have a home school in the middle of the dining room. And, you know, the stories go on and on. Juice spilled all over a brand new laptop, internet access not working, parents not remembering 3rd grade mathematics. So it's just been a crazy, crazy time for parents. Look at this next question. A popular 2020 meme was Da Vinci, and it came about when 1, an animated image of Sergeant Schultz winking at Colonel Klink's assistant Helga went viral. 2, a do-it-yourself video about making keys using automobile VIN codes went viral. 3, influencers mispronounced the answer to the question, "Who painted the Mona Lisa?" and it went viral. Or it's a sleep emoji, didn't quite work right, and it went viral. And if you guessed Da Vinci became Da Vinci, you were right. Twin brothers Chris and Patrick Voros were taking a trivia quiz, and they were asked who painted the Mona Lisa. Neither knew the answer. When Da Vinci popped up on the screen, they responded in unison, "Da Vinci?" And then finally, for waking up your brain this morning, let's take one more quiz question. And we all probably spent too much time in front of the TV last year being locked inside so much. So let's try to guess which of these shows was the most watched in 2020. Was it Lock and Key? Was it The Queen's Gambit, Space Force, or Tiger King? And if you guessed Tiger King, you were correct. It actually won the blue ribbon for the most watched TV. Now that we've woken your brains up a little bit, let's go back in time and talk about where we've been in this past year. I'll first talk about the economy. So trying to get the economy up to speed. Let's start off by talking about the U.S. economy. It was like a semi-trailer truck. No one likes being stuck behind a semi going uphill or at a stoplight because big trucks don't go from 0 to 60 very fast. neither does the U.S. economy. In 2020, the COVID-19 pandemic brought our economy and economies all around the world to a virtual standstill. The U.S. government and the Federal Reserve took extraordinary measures to help the economy get going again. Congress passed the CARES Act stimulus, which gave Americans and American businesses badly needed fuel to support economic recovery. Businesses were able to stay open and people had money to spend. That is important because consumer spending accounts for almost 70% of our U.S. economic growth. Federal Reserve smoothed the road ahead by pushing money into the economy, and they went out and were buying bonds. The Fed kept rates near zero, if not zero, and promised to buy unlimited amounts of government bonds to keep them low. It also actually bought corporate bonds, which let companies borrow. They even mentioned they would buy junk bonds if they needed to. All of this ended up being an increase in the money supply. And so they wanted to supply the system by flooding financial institutions and promoting increased liquidity and increased lending. This chart, the next chart here, the U.S. economy started gaining momentum, is really about measuring the year-over-year change in economic growth, or GDP. It measures the value of all goods and services produced in our country. And this goes through the third quarter of 2020. There was a sharp drop in the first quarter of 2020 when COVID-19 arrived. People hunkered down and businesses closed. And as you can see, government stimulus and central bank policies helped Americans get going again. The recovery was gaining momentum like a semi pulling away from the stoplight as we flattened the curve on the virus and states began to open. And you can see the recovery here at the end from where we were starting to move back up. Again, that's the end of the third quarter. But then, as you can see here, we got hit by a new wave of the virus. And this new wave hit hard. The number of cases increased around the world. And in the United States, we saw the number of new cases increase significantly, particularly in November. Hospitals became overwhelmed. Congress was unable to agree on a new stimulus package until late in December, when the economy was already beginning to falter again. Reopenings soon became reclosings. States began to issue stay-at-home orders again, or for the first time stay-at-home orders, and Americans became reluctant to travel. They quit going back out to eat in restaurants again, and they started spending more time inside public, or quit spending time inside public places for fear of catching the virus. And as you would expect, monthly employment gains certainly have stalled. The slowdown in demand caused businesses to hire fewer workers, and the chart shows essentially what happened here. There was just a cliff when everything hit, and it started recovering, but when we got back into the second wave, it started slowing again in September, and in November and December, it really did not increase hardly at all. Next slide here, unemployment remains elevated and not going to be a surprise to anyone here. The stats that are out here show that the unemployment rate cited in the monthly unemployment reports, which are U3, the dark blue bar, they reached 6.7% in November and stayed there into December. The U6 rate, the lighter blue bar, which includes discouraged workers who stop looking for work and people who are working part-time because they can't find full-time work, moved slightly lower from 12 to 11.7 in December. So again, there was a big spike. It started recovering, but through both of those numbers, by the time we got to September, things had started to level out a lot more and the recovery started to falter. Next slide here. Good news though, consumers were still spending. Despite relatively high levels of unemployment, consumers were spending. And as I mentioned in my mid-year outlook, this has hit different pockets of the economy a lot worse. Travel industries, retail industries, food service industries, these areas were hit hardest, which have actually a lot more people at lower wage levels. And so it's an interesting thing to consider, but people with higher paying jobs were actually more likely to be employed. So therefore you see the ability for people to spend actually stayed relatively the same. One shift that you can see here is that the change in where they were spending money. So this is through November, which is when the most recent data was created. And because it drives U.S. economic growth, we really want to pay attention to consumer spending. The blue line, which you can see is about the third one down on the right side, was previous year's levels, was below previous year's levels, I'm sorry, but only by 1.3%. So that's pretty amazing when you think about it. It was only 1.3% less than it was in 2019. The red line shows spending on services, which are things like haircuts, restaurants, bars, and manicures. That was down almost 7% year over year in November. The purple line is non-durable goods like masks, gloves, gowns, and PPE stuff. That was up 4% through October. And durable goods, so these are things like automobiles, home furnishings, freezers, that was actually up 13% year over year. So in a year like this one, it's important to think carefully about these statistics. For example, an expert could say consumer spending was up 15%, and they'd be right, as long as they were only talking about durable goods. But overall, spending was still down compared to year over year. But we were still spending, and it was close. Next slide. Statistics do tell these stories, but they can be misleading, certainly. So economic GDP offers a good example. The black line here shows percent change in GDP compared to last year. The blue line shows the percent change in GDP compared to the previous quarter. So if we go and look at the third quarter, what was the percentage of change in economic growth? In the first two quarters, the U.S. economic growth contracted, and you can see both of those lines went down together. Now let's compare to the previous year's economic growth. In the years when there are enormous moves, statistics can be distorted and misleading. So looking at this one, if you compare quarter to quarter performance, the blue line, the percent change from the second quarter to the third quarter was up 7.5%, which sounds absolutely wonderful. But when you look at it from a year over year perspective, you see that we're still down about 3%. So let's take a look at this next slide about the economy. One thing we all know, that by the time November and the fall had gotten here, anxiety levels were already rising. Again, I should say. People are more stressed about their finances than they've been since the summer, is the quote that we put here. And some statistics here. And it's a poll that went out in November. And again, it can be skewed by polls, but looking at it, 22% of households polled said their household debt had risen in November. 46% were worried about their job security. 47% were worried about paying bills. 15% said it was getting harder to pay the rent or mortgage. And if they were investors, their worries may have been somewhat relieved by the performance of the stock market, because that seemed to be doing good by the time this rolled around. And I would just happen to mention as well, for retirees, we saw a cutback in spending, and actually the same level of income, their portfolios were going up. So actually retirees were an interesting group of people that actually felt they were in a better financial situation. Now, still anxious about health-related items, but a very interesting perspective. So speaking of that stock market, let's shift over and talk about it. The U.S. market sped past the economy in 2020. It did end the longest bull market in history, recovering from the 07-08 financial collapse. But we also had the shortest bear market in history. And after the bull market was over, the short bear market was over, we were actually hitting new highs last year. So if the U.S. economy is a semi-truck, the American stock market is a sports car, and it sped right past the economy super quickly. In 12 months, we experienced the end of the longest bull market in history and the shortest bear market in history, all in the same year. And again, as I mentioned, hitting all-time highs. So let's look at the next slide here. There was a lot of volatility though. The black line here is the S&P 500. After a sharp downturn early in the pandemic, the index came roaring back. The purple line is the volatility index, or often known as the VIX, which is sometimes referred to as Wall Street's fear gauge. It reflects what investors' thoughts are about how volatile stocks will be during the subsequent 30 days. And you've probably spotted the relationship between the two already. During 2020, when investors were worried about what might be ahead, the S&P tended to lose value, When people were optimistic about what might be ahead, the S&P index tended to move higher. It illustrates an important fact about stock markets and helps explain why they did well last year when the economy was contracting. The stock market, as we always talk about, is forward-looking. Its performance reflects investors' expectations for the future, not necessarily the average retail investor, your neighbor across the fence, 6 feet away, of course, but the actual institutional world and what most folks would refer to as the big investors. But let's take a look at the next slide. It was a bumpy year. So this is a slide that shows how many up or down 1% days that we've had. Investors were certainly off balance last year. There were a lot of uncertainty. There were 109, as you could see here at the end, when the S&P index moved higher or lower by 1% or more. So that is in the top 4 most volatile years that we've had in the since this slide goes back to 1996. But the other 4 years were 2002, 2008, and 2009, as you can see there. So it was an extremely volatile year. Next slide here shows significant disruption has led to attractive returns, though. So when you think about what happened in this dynamic, large companies, how they perform relative to smaller ones, you can see that here. And you can also see how growth stocks benefited from the view that disruptive companies or technology companies would prosper in 2020's unique circumstances. So in our opinion, the pandemic accelerated the growth of things like internet sales, work from home themes, things that were slower trends coming along, but they were coming along, and we just feel like that really accelerated, and the stock market agreed. And so you can see here, large growth versus large value. It was a very distinct difference in these. Even growth and value in the small size companies. So big disparity in the difference in how we look at the different types of stocks that we buy. So I always say at this point, if you were a dividend paying or dividend investor who was looking for blue chip, long-term companies, they were really left behind last year. You had to be willing to not take dividends to pay pretty high prices for the potential for future growth. But if you did, you were rewarded. Again, this is a reason to be diversified, but I just wanted to mention that because you could have a very different experience between two investors that happen to be all in large U.S. stocks. There's just some dividend value investors and then some growth investors that experience 2 different years. And then the next slide here shows what happened late in the year when we started getting positive vaccine news. And that started to change and the value stocks started becoming more popular. And so you can see this basically started from November 9th through the end of the year. And so vaccines really help investors begin to see a point when the world might reach this new normal and all of a sudden value started recovering. And that's actually continued into 2021 so far. Next slide. This is from James McIntosh from the Wall Street Journal. He asks, is it finally time to buy back into the shares of the unloved and cheap companies? On Monday, these value stocks beat expensive growth stocks by the widest margin of any single day since the 1930s, as vaccine progress improved the prospects of the beaten up losers of lockdowns, such as airlines, cruise lines, and things like that. The questions investors face is whether Monday's extraordinary move marks the end of a grim decade and a half for value, or is it just another false dawn amid the gloom? And this is a tough question. I would mention to you having growth and value is very important to us. If you think about maybe the next 3 to 5 years, you may still feel that growth is at a slight advantage. But there's definitely some room for improvement on the value side if we start to see further recovery. Vaccinations are really becoming prominent and distributed well, and people are feeling confident to go out both in business and on the consumer side. Next slide here. While the value stock question remains unanswered, we do know that valuations for indexes like the S&P 500 have risen to high levels. This chart shows price to earnings, and most of the time we hear that as a PE ratio is the term. These ratios compare the current share price to its per share earnings. And of course, you can say, well, which earnings? Is it the future expected earnings, or is it the past 12 months? Is it the past 5 years? And so we want to make sure that you understand that. But this is a measure that helps investors understand whether their company or an index in this situation is inexpensive, fairly priced, or expensive based on how much earnings are coming in. And the black line here on this chart shows the trailing PE, which is the last 12 months. And the blue line shows the forward PE, which is based on the estimated next 12 months. And both of these numbers have risen significantly. You can see a big drop off in 2020 at the beginning of the year during COVID, but both of those numbers are at all-time highs for the last 20 years, which basically is saying we need to be mindful of where the stock market prices are today. And the next slide here, why did the stock market do so well? Well, there's a lot of different reasons, and we've certainly been asked this question, maybe more than any other. How did it do so well when the economy isn't? What's going on? I just don't trust it. And I would tell you there's not one reason. Supportive central bank policy certainly helped. Around the globe, central banks kept all the interest rates low so companies could borrow inexpensively or refinance debt. In the third quarter, the Bank of International Settlements calculated that low interest rates were responsible for close to half of the rebound in the U.S. market, and a fifth of the rebound in the euro market as well, too. Next, you can see government stimulus certainly helped. In the U.S., the CARES Act delivered $2 trillion, and that type of stimulus, fiscal stimulus is certainly going to boost optimism in stock prices. Don't fight the Fed saying, if they're throwing money at you and they're keeping interest rates low, it's going to drive prices. For much of the year, 5 companies, of course, in the S&P 500, which we call the Big Five, outperformed the other 496. And I talked about this before in the July outlook, but it just kept going. It did peak out in early September. Those Big Five, the top 5 companies in the S&P 500, which are Apple, Google, Microsoft, Amazon, and Facebook, they represented 25% of the value of the stock market. They were up around 65% year over year from September to September. The other 495 companies were only up 3%. So if you bought all 495 companies and skipped those 5, your experience with the S&P 500 would not have been even close to a comparison. So those Big Five have also benefited from very unique circumstances created by the pandemic too. You think Google, you think of people searching on the internet like they've never done before. You think of Amazon shopping from home. You think of Facebook and people getting online to see their friends and stuff like that because they can't correspond to anybody else, not to mention politics and all the other things people jump on social media for. Microsoft, more people ordering equipment and things like that to bring them into their house. And so all of these have some very distinct and interesting reasons why they did well. And then, of course, let's not forget that the stock market reflects what investors will think will happen in the future. And so people are expecting that a new normal will come back and it will arrive in sometime in 2021. So again, probably ahead of the curve, but that's what the stock market does. And then the last one I've got up here is the low interest rate environment. So low rates cause investors to really take risk where they probably shouldn't have if they were trying to stretch for making more money. And or you think about the people able to borrow more. And so you saw that, the housing market did extremely well. They can go back and borrow against their house with a lower interest rate, take money out, and then go build that pool in the backyard or whatever they were trying to do. So a lot of stuff that really did promote the markets. Speaking of the low interest rate environment, the next slide here, it's hard to argue this. This chart shows rates for 10-year government bond in various countries. The U.S. Treasury rates were low, below 1%, but they look positively generous compared to Germany's negative rates. The difference between Germany and U.S. yields is related to supply. So even with the Fed buying treasuries, there was plenty of supply available. The German government issued less debt post-COVID, and the amount of bonds that were available to private investors declined. So if you sort of look at this, the 10-year bond for Germany is the red line, which is all negative through all the year, negative yields. And then the green is the euro, purple is the UK, and blue is the United States. But we did start to see some movement in treasuries at the end of the year move a little bit higher. So that always brings the question, well, is this the year that the bull market for bonds ends? And that has gone on now since before 07, 08, really since 01, 02. Everybody's been waiting when the decades-long bull market in bonds might finally be here. So they peaked bond yields in 1980s, and many of you will remember that. These bond investors have benefited from falling rates and rising values, but most of those bonds are now gone. They've matured and they've been reissued. If they were reissued 10 years later, that's happened 4 times. So this inverse relationship between bond rates and bond values, it has to be appreciated, but that's also where these questions come from. When rates rise, as may happen in the future, will bond values fall? Most certainly to some level, but we need to wonder how long and when are our maturities. And so if you're counting on bonds to generate income, you want to make sure you haven't taken too much risk with the actual capital. So if rates start to move higher, your bonds may go down in value. That could make your retirement a whole lot less comfortable. It may not mean that your income's cut, but you may have locked yourself into these low rates. So again, one of the things we focus on is making sure we're nimble. And this is not a time to go out and, in my opinion, buy a 25-year bond and lock yourself into these interest rates. And why is that? Well, the next slide here, inflation may be edging higher. We've been asked about this. One thing that could cause the Fed Reserve to rethink low interest rates is, of course, what they're supposed to do, which is fight inflation. Economists love to disagree, as the slide says, but almost all of them will tell you that inflation is dead. This premise of low inflation is baked into economic policies and financial markets across the globe. And so, this inflation edging higher thought is one that starts to be scary because you wonder how that's going to impact everything else. And you look at this next slide here. Some of today's inflationistas predict a possibly high but transitory spike in prices as consumer spending bounces back from the pandemic. So economists at Morgan Stanley predict a fundamental shift in inflation dynamics, with inflation rising to the Fed's 2% target by the second half of this year and going to overshoot it. And so there are folks that do believe that we're at a turning point now. I will tell you, back in 2009, my entire industry told me that with the amount of debt that we took on from the federal government to bail out Wall Street and bail out the real estate market, we were going to have massive inflation. And here we are 12 years later and have not seen it yet. So again, don't put all your eggs in one basket, but this is some different viewpoints. Next slide. And of course, we know how this goes as well too. Keep politics out of your portfolio. And I just flat out say I did a whole presentation about a week before the election and just went into all the reasons why you should not ever think about politics when you think about your portfolio, particularly if you think about your portfolio from a long-term perspective, because politicians will change. And if you think about it in the here and now and you're a retiree and you need your money to live off of, well, you should build your portfolio based on your income needs and not what you think is going to happen in the Oval Office or in Congress. We always say 2 things. Government is either something to jump in front of when they're spending money because they will push dollars into areas and there's opportunity, or they're looking for ways that they can take money, and so we need to avoid those for our clients. So again, they can be a risk and an opportunity, and everybody's a little bit different when it comes to that. All I can say is whether Democrats or Republicans are in charge, keep them out of your portfolio. And so you can see performance here. And again, whether you're conservative and you think Republicans would help you out in the stock market, or whether you're a Democrat and you think Democrats will help you out in the market, you can see there are certainly periods of time when it just doesn't matter. I always say what happens during a presidential term is more important than who's the president. So that's it for where we've been so far. So now let's shift gears and talk about where we are. As we think about where we are today, we certainly have to address this. More and more people are working and learning from home. And they're also learning to cope with that now that this has gone on for quite a bit of time. Work at home warriors, as I like to title them, have survived the shift to video, the meetings, to experimenting with all kinds of filters, hearing and sharing unexpected clamor from family members in the background. And we've still got a lot of work to go, but I remember having one meeting with my team, and John, who was working from home, he's got a 2-year-old and a kindergartner who has started kindergarten virtually and still been virtually, is sitting there. I can hear the kids screaming in the background, and I watch his cat jump onto his chair behind him and jump on his head in the middle of our team meeting. But he took it with stride. The team's getting used to this. We try to figure out what's the best way, and we're not alone. There's a lot of people who are figuring out how to be productive in this very different environment that we're in today. So let's take a look. As we finished 2020, investors were bullish on stocks, and we've seen that continue at the beginning of this year. There is a AIII investor sentiment survey that goes out, and this is all individual investors, not retail investor, not advisors and not institutional, but individual investors, and which many believe is a useful contrarian indicator because they feel like individual investors usually do the wrong stuff. They found 50% were bullish. So the historic average is 38. So again, 50% bullish, a little bit higher than average. In a Project Syndicate blog, Nobel laureate Robert Shiller, who we track his stuff quite often, explained the allure of these stocks. With interest rates low and likely to stay there, equities will continue to look attractive, particularly when they're compared to bonds. And so again, that's why he justified why we're seeing this bullishness. CFOs weren't quite so optimistic though. Deloitte CFO Signal Survey reported with the S&P above 3,500, 80% of CFOs thought it was overvalued, but 60% thought it would still go higher. And so you can see the national leader from this program says, I think many CFOs believe that at one point in time we'll have a pivot where the capital markets will be more aligned with the real economy. And again, I think there's a lot of people that share that sentiment, but basically they're saying, that stock prices are overvalued. And so there's two ways that changes. Number one, earnings go up, or number two, prices go down. And then obviously there's the combination of both. Shifting gears again, the mix of opinions reflects a very different perspective of these groups, but it also reflects these unique circumstances. The development of effective vaccines provides hope for the future, but we are not there yet. So the chief investment strategist for Schwab, Liz Ann Saunders, she said, if vaccines represent the light at the end of the tunnel, the virus means we are still in a fairly dark part of the tunnel today. And so I think that's pretty much shared across the board. We're starting to see the vaccines come about. Still a lot of uncertainty around the vaccine itself. More to be coming. There's treatments coming, but there's also distribution issues. And so, there's still a lot of way to go, a lot of the way to go to get out of the tunnel. Regardless, though, the light at the end of the tunnel does inspire folks in the stock market. And so since the outperformance of the big five peaked in September, as I mentioned, we're starting to see this rotation. So we're starting to see growth go to value, large go to small, defensive companies go to cyclical companies, stay at home stocks are going to out and about stocks, and the leaders of the last year are starting to become laggers in the 2020 market that we have. So while these changes in thinking reflect the future, we do anticipate a stretch of rough road before we get to the end of the tunnel here. And so the next slide here shows what kind of things are going to make the road rough. Well, here's a few. And I mentioned it already. We've got to overcome 15 billion doses of vaccine to be delivered around the world. They have to get government approval. We have to get production capacity. We have cold storage issues, cold shipping issues. We have this natural reluctance for some people to get vaccinated. So that's certainly one issue. Unemployment is high, and historically that hurts. It lowers the likelihood of finding a job. So if you were out of work, it's hard to go back and get a job. And it also basically allows people to say, I can't get a job. I'm just getting out of the workforce and figuring out what else to do. And sometimes that can be very terrible. And that we need productivity, so we need people to work. For example, if one person was dropped out, lost their job, but the spouse is maybe they just transitioned to a different standard of living, which is not as productive for society, but they managed it because that person couldn't get a job. Small business destruction. One threat to long-term unemployment, but also to our economy, is the loss of millions of small businesses to pandemic closures. I mean, there were a lot of small businesses that end up being big employers, right? Because collectively, lots of small businesses hire lots and lots of people. So in 2019, small businesses employed about 60 million people. That's more than 47% of U.S. workers. One piece of good news, though, was small businesses are proving to be resilient. And new businesses have been opening throughout 2020 and into 2021. And I love that story. That's a story of America. That's a story of innovation. That's a story of getting out there and taking the risk to make something happen. And it's still alive and well today. So I love to see that. Obviously, economic relief packages, and that's a huge one, but also these safety nets that they're looking at. And we're hearing about it right now. So we got the latest COVID relief bill in December, and then we've also had provisions restored, including relief checks, extending unemployment benefits, eviction moratoriums, and funding for business and vaccine rollout. So there's different ways that the government's stepping in here, but still, again, a rocky road. Interesting one. In a year when so many have needed so much, Americans stepped up. And, I'm proud of that. It wasn't easy to know where to give, though. As someone from the NASDAQ mentioned, in a year like 2020, choosing where to direct your dollars is like picking your favorite child. Should your money go towards nonprofits that provide basic needs, organizations fighting for social justice, or campaign to help your local small business stay afloat? And so, again, we were generous. There a lot of money got spread around in a lot of different ways. For example, during the first half of 2020, giving increased by 7.5% over 2019. Grants from donor-advised funds were far higher. Schwab reported a 46% increase in dollars granted for charities during the first half of the year. And donor-advised funds are something that we set up for people who would like to establish a donor-advised funds. They do provide a tax deduction when assets are contributed to the fund, and not necessarily when they're distributed. So someone may have put some money in when they wanted the tax deduction, and this was the year they finally took some money out. So, but it's good to see that. So that gives you a little idea where we are. Rough road that we're at right now, and where we, in the short term we're going to be going. But still a lot of hope and positivity that we see. So now let's shift gears and talk a little bit about where we may be going. Reconfigurations of work and learning have caused many of us to reevaluate how we spend our time. Many have discovered that time is certainly a precious commodity, especially when you are working from home with children or even pets. I have a new pet, and it is definitely taking a lot of time. And we also, just generally trying to be more efficient. There's a lot stretching us out of our norm, and so everybody's trying to be more productive and more efficient. So this next slide here talks about it. Ben Franklin in 1748 was quoted by saying, "Remember that time is money. He that can earn 10 shillings a day by his labor and goes abroad or sits idle one half of that day, though he spends but 6 pence during his diversion or idleness, it ought not to be reckoned the only expense. He hath really spent or thrown away 5 shillings besides." And so, again, how should we spend our time? Well, being productive in society means you probably need to assign a value to it. And again, one of America's earliest financial educators helped us do that. And he believed work time and non-work time had the same value because non-work time could be spent working. Today we value our non-work time, but how much is it really worth, especially when it comes on the back of not getting a job again. So it can be a little bit scary. So let's talk about this worth of our free time. We all know that how much our employers believe our time is worth because they give us a wage or they give us a salary. The value of our work time is reflected in prices of goods and services, in investments, in productivity and economic growth. So the question is, how much is our non-work time worth? Again, if our work time justifies the prices that we all pay, because that's how much employees cost and all these things go into the formula, what about the non-work time? Well, the U.S. Department of Transportation has spent a significant amount of time determining how much time is worth because it helps them decide where to spend taxpayer dollars. The 2016 report valued local personal travel at 50% of hourly income. On average, in the United States, that came to $13.60 an hour. In 2020, a team of data scientists and University of Chicago economists teamed up to measure the value of our time by determining how much people are willing to pay to spend less time waiting for their rides. They set the value of our time at $19 an hour. Of course, during rush hour, rainstorms, and snowstorms, the value of not waiting increases actually by about 50%. So another interesting one here. All right, so let's take a look. What's ahead? Well, some of the trends that began last year are likely to continue. You can see here, working from home, housing market boom. So working from home meant spending more time at home, and many found they did not have enough space to do what they wanted. So there's this boom in the housing market, and we see that continuing. Americans are saving more than they ever have. It's possible that this will change when there are more ways to spend money, but we actually hope this trend continues. So more people are saving. We saw it directly in our business with our young working employees, clients. They're definitely bringing more money to the table, and I think some of it is forced. They can't travel. They can't spend it on certain things, and some of it may be fear-based. But one thing to be mindful of also is some of it's the fact that they see the market recovery through this, and they wanted to get in on it as well too. So some of it can be a little greed-based as well. The next one here, sustain innovation and technology adoption. During 2020, companies had to innovate to survive. And we hope and we think innovation will continue, and we do anticipate that technology will play a significant role going forward in things like education and health, in buildings, in cities, and elsewhere. Not a surprise, but the demand for cleaner energy in cars is increasing. Like the rest of the energy sector, renewables experienced a setback in 2020. However, governments in the U.S. and around the world are setting new rules that favor these electric vehicles. I guess electronic as well. Japan has set a 2030 deadline. California has a 2035 deadline, and France has a 2040 deadline. So we do anticipate the trend towards clean energy will be driven by the consumer side too, buying these clean energy vehicles. And then, another one that's out there is this pursuit of social justice. This isn't something that just came and is going to disappear from the news. In December, for example, the NASDAQ announced plans to require the more than 3,000 companies listed on its stock exchange to improve boardroom diversity by having 2 diverse directors. It's a change that could really benefit investors because studies have found that having women on company boards results in better acquisition and investment decisions and less aggressive risk-taking, which have actually benefited shareholders. So when you think about this, there's a real monetized benefit for pursuing social justice across the board, and it shouldn't be politicized the way that sometimes it is. It should be really appreciated for what it is to bring an extra viewpoint in, and the more viewpoints we have, the more collectively we can tackle things that need to be tackled and look out for risks and identify opportunity. And of course, across the board, we do expect to see economic recovery around the globe. It's not a surprise that economic recovery from a low place doesn't necessarily mean fantastic results. And I said it earlier in the slide, but we do anticipate the world having a 5.2% annual change year over year. And so the U.S. is in there at 3.1. You can see countries like China and India having stronger rebounds. Those were countries that were growing faster anyway. So it's pretty interesting to see that we do anticipate this across the board. And again, I have to kind of throw it the other way to think about it. It is probably going to be an unusual year. If last year was unexpected, I would say that this year is probably going to be unusual and unexpected too. World economies rarely move in lockstep. So when you look at it, in fact, a synchronous global recovery where growth in both developed and emerging markets accelerate in the same year has happened only a dozen times in the past 40. So the last was 2017. The stage could be set for another such sync coming up in the next quarter, but we'll have to wait and see. And I think a lot of that has to do with some of the things we mentioned before. In 2017, a lot of that was the anticipated end of what I will call the Trump-China negotiations. And so there was an anticipation there that we were coming to see the end of what had been a pretty difficult environment globally for trade and things like that. And there's starting to be, phase 1 and phase 2 coming out, and then it halted. And so that's what we saw. The pullback in 2018 was derived from. And then 2019, we're starting to see some progress again, but 2020 again threw us for a complete loop. So why may this be? Well, there's the free trade agreements. While economies may be moving in sync, trade agreements launched during 2020 may help some nations grow pretty quickly. So November 15th of 2020, 10 members of the Association of Southeast Asian Nations, and we refer to that ASEAN, and 5 regional partners signed the Regional Comprehensive Economic Partnership, this RCEP. The Economist reported it was the world's largest plurilateral trade agreement ever. Some RCEP or RCEP members also participate in the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, also known as the CPTPP. So this connects 30% of the world's people and output. The anticipation is that this RCEP will raise global GDP in 2030 now by an annual 186 billion. So the CPTPP will increase global GDP by 147 billion. Right now, we're not participating in either agreement, but that may be changing, so we'll have to see. So let's talk about some of these risks that we see. So the risks that are out there certainly expand beyond these 5, but these are certainly 5 that have the potential to affect the stock market. So vaccine effectiveness, will they be as effective as expected? Of course, with possible mutations and variations in the virus, can we hope that this vaccine continues to fight effectively? Number 2 here, the pace of recovery. How quickly will the economy bounce back? Will people actually find work quickly, or will it take a while? I mentioned it just a second ago, but number 3 here, U.S.-China tensions. Before the pandemic, the trade tensions were really disrupting markets. I don't know that the relationship's going to come back to be a hunky-dory. We do believe it will remain pretty contentious, even with the new president. Consumer habits are something we have to watch. We mentioned it's over 65 to 70% of our GDP. Will new habits that these consumers formed during the pandemic change business and business models? And will they keep ordering groceries online? Will they keep working from home? Will they hesitate to take public transport? So all of these things are questions. And then finally, investors are getting more ambitious. Call options, options are more prominent out there. There's more trading investing than there is actually long-term investing. So there is inherent risk in that. But again, this risk changes depending on how people behave. And for people who started in April, they think the stock market goes nowhere but up. There are areas of the market that we've seen, tremendous returns, and people get this bias to think that they're some kind of brilliant investors because they bought into something that went straight up, and they think it had something to do on their own accord. It's just not true, and we hope that doesn't come back to bite the market overall as people freak out on the other end when their stocks don't go just straight up. This is one that many people talk about, and I believe it's something to talk about. I don't lose sleep over it because it's out of our control. But debt levels do slow economic growth, and we've taken on a lot of debt. This national debt is how we get out of crisis, but when do we start reducing that debt? And according to this slide, we really haven't done it since the late 90s. So, it's an interesting time. So, how much we owe to GDP is what this slide is showing us. And it's important because research have found economic growth falls by about 50% when debt exceeds 90% of GDP, and that's where we're at. So we do have to be mindful of our national debt, and we have to see how it's impacting things. The easiest way to get out of debt is for the economy to recover strong, and when it recovers strong, then you pay down your debt. But that's really easy to say, and obviously hasn't been real easy to do. In Barron's interview, Jim Rogers, a founder of the Quantum Fund, he mentioned this national debt as a serious concern. He said, a year ago at this time, America was the largest debtor nation in the history of the world. That debt is now up by trillions of dollars. That's trillions with a T. Someday we're all going to look back 3 years from now, 8 years from now, and say, wait a minute, what about all this debt? What are we going to do now? And I think that's a very, very good thing to consider. And like many things that we do in America, we will probably react to it when it becomes a crisis and not be proactive, unfortunately. So, it's something that I do believe is a concern. I don't think that you necessarily need to change your portfolio or change your behaviors based on it, but it's something that we need to look at as a society and decide when we're going to be proactive about trying to tackle it. And then I'll shift a little bit here and talk about legacy planning. So one of the things all of us need to do now, or at least during 2021, is review our legacy plans, because there are big reasons why we should do that. So the Secure Act changed rules for stretching IRAs over generations. Some legacy plans need to be revised, Roth conversions, which are more attractive when tax rates are low. So there's things that we've been doing that we need to be mindful of. Number two, the new administration is planning to change tax policy and increase income taxes. Two thresholds, but certainly people with income above $400,000 will be particularly vulnerable if these plan policies become law. And if you're over $1 million, it's pretty miserable for those folks. They're going from really like things like capital gains and dividends and things like that are going to be taxed at the highest tax rate, and that would be increased, so they'd be at 39.6. Plus you're going to take on the North Carolina, so now you're about 45, plus you've got 3.8% Medicare tax on top of all your investment income. So, now we're at 49%, and then they're going to reduce all of your deductions. And so you start going and you're seeing these things. And I do have a few clients that make more than $1 million a year. And I can tell you in every situation that I have a client that does that, they are extremely successful people that have created multiple companies for multiple opportunities for people to be employed. So it's interesting to watch this happen and sort of unfold it. And I'll even give you, so people say, well, that person has a lot of money, they're fine. And I get that. These are still people who share values that most people do. One did not want to give away a bunch of money last year to take advantage of the tax code because he doesn't believe his children need to get but so much when he dies. He believes they need to work for their livelihood and things like this. So these aren't these crazy, strange, rich people. These are people who are local people who have created very successful companies and have been rewarded for it. And they are certainly going to get impacted differently than a couple who makes, $100,000 a year. And whether they should or shouldn't, I'm not here to say that. I'm not going to cast opinions, but I can see the numbers. I've studied the tax law that's out there. And in many situations of people in the lower levels of income, and I would say pretty much most people under $250,000, but I would maybe stretch up to $400,000. there are a lot of tax advantages that are coming in these tax packages. So I see that it's going to be easier to get it passed. So I would just say that there's a likelihood that we see tax changes. I will say that it's more likely in 2022 than 2021. So do your planning accordingly. We'll probably talk about this in more detail at some point in time, and we'll put out some communications around it as we get more finalized around it. But it is something that is coming. So with that, let's take a look and let's see what some of the experts say about what's going on and where we may be going. Every time I have this presentation, I always add in this section. I think it's important. We have a lot of clients that have come to us and say, well, this is what the big names are saying, or this is what I heard on TV, or this is what Jim Cramer said. Whatever it is, someone's always got opinions, and there are a lot of brilliant minds out there. But there's a reason that nobody can predict the stock market, and nobody can predict the economy, and nobody can predict political outcomes. And the way of the world is unpredictable. With that said, I do think it's important to try to grasp as much as you can so that you're prepared for the risk that may come and the opportunities that may present themselves when you have a little bit more of an educated guess about the future rather than just a blind exposure to it. And so I like to show these expert things, and I like to show some difference of opinions too, to get your brain thinking about things that are not just in a vacuum or not just one view. So let's take a look at some of them. So many of you have probably seen or heard about Stanley Druckenmiller. This was from a Squawk Box interview in September. I have no clue where the market is going to go in the near term. I don't know whether it's going to go up by 10%. I don't know whether it's going to go down by 10%, but I would say the next 3 to 5 years are going to be very, very challenging. I think that that's a pretty fair statement. And I think that bodes well to what we should always think about when we think about investing, is that it is a risk return dynamic here. You are not going to make money without risk. And I would tell you it's when you need your money the most is when you need to manage the risk. So you build portfolios based on your time horizon and your cash flow needs, and you don't take risk that won't make you meet your goals. Another view here from The Economist, this from November. COVID-19 has brought with it economic damage on a vast scale. Yet the rapid changes that have been forced on many industries are leading to innovation that will outlive the pandemic, and in some cases are leaving incumbents less mighty than before. And so I think that's an important dynamic to think about as well. Innovation is important. And I think that one of the famous ones that comes to mind is that there was a company that delivered ice to people. They used to go harvest ice and bring it. And this is, of course, many, many, many years ago. And then there was an ice factory. And then there was the ice maker in your refrigerator at home. And in all three of those situations, the plain and simple truth is they were trying to deliver ice to the people. But it was not the same company every time, because each company failed to innovate and keep moving forward with the same end goal. They still were unable to innovate. So I think that what you're seeing here is that there are people who will be forced to innovate, and some will do it well, and some will do it poorly, and that's the opportunity for disruptive change. And that's where one stock may falter where a new stock comes about. So just mentioning that. Stephanie Kelton, she's an economist and a public policy professor. She's with the Barron, said in December, how we work is definitely changing. That could have long-term disruptive effects on our air travel, on our commercial real estate, which we hear lots about, downtown restaurants and such. We also know we're going to lose potentially half of all small businesses. That's going to have a big impact on everything from corporate concentration to the makeup of local communities. That's a bit scary in a lot of ways. I don't necessarily think we're going to lose half of all small businesses. Although you may argue we may lose half of all today's small businesses, but we will have new businesses that come about, and certainly there's going to be change ahead. So I think it's important to understand that and try to figure out what that means, and hopefully companies will evolve to meet the demand that we have so that the economy keeps moving forward. Here's another one. this is, and I don't know how to pronounce his whole name entirely, but Beschloss is his last name, and he's the founder and CEO of the Rock Creek Group. And he said climate. It is going to be huge in terms of investment. The private sector is going to lead. Companies are moving towards clean energy because they know it's not just regulation, it's their consumers that are demanding it. And so I think that this is an important one. And of course, there's a lot of talk around that with the change in the presidency and the Congress. And so that is something to keep an eye on. I will say that clean energy has had a tremendous run up as of late, almost to the point where it's starting to get scary. It can continue to go in that direction, but in a lot of ways we've seen the idea of clean energy coming to the front already priced into the stocks. So just be mindful of that. And then another expert that I brought up before, but Liz Ann Saunders from Schwab here. Whenever the market is trading at or near all-time highs, it's important to assess the risk. Sentiment remains a key risk, especially given the economy remains inside this tunnel, which we talked about earlier. Even if vaccines represent the light at the tunnel, investors should remain disciplined, diversified, and opportunistic with regard to rebalancing their portfolios. And again, I couldn't agree more. Stay diversified, stay disciplined, make sure you're investing to your needs, risk tolerance, time horizon, cash flow, all of those types of things, and you will weather whatever 2021 and the future holds. No one knows exactly what the future will bring, but you can build and position your portfolio to avoid unnecessary risks. We spent a lot of time talking about the global outlook for the economy, for global economies, for U.S. and international financial markets, but it's just as important, actually it's more important for you to know how your lives are going to change throughout the coming year. Whether it be marriages, births, deaths, children, grandchildren, great-grandchildren, job changes, what kind of issues are going on in the neighborhood? What kind of things are going on in your house? Will you need to do major repairs? Do you need a new vehicle? All of these things that are going to affect your cash flow and really your life. And those are most important to the way you position your portfolio. So I'll leave you with that. And I'll just say that I can't take any questions today because it's a virtual presentation. But if you have any, here's our contact information. My email is Jason, Jason, @pathfinderwc.com. Again, thank you very much.
Thank you, Jason, for a presentation. It was very enlightening.
Absolutely.
You like how we do that? Anyway, next video is going to be the mayor. So if you have any questions for the mayor, good, bad, or ugly, send them to George, and he'll pass them on to us, and we'll print them out, and we'll ask the mayor for you if you have any burning questions. And thank you for all watching.